Coffee prices have risen sharply over the past year. Starbucks shares have not, and they're going to be reporting after the close tomorrow. So we're going to take a look at that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we try to take some of your questions and also take a look at some of the events that are upcoming and see what the options markets are implying about those things and whether there's anything to trade within them. So, as I just mentioned, Starbucks is going to be reporting tomorrow after the close, and it's implying some pretty big moves. And I just had a couple of charts here. I apologize. They're not in the greatest resolution. I actually threw them together in a PowerPoint because I thought it might be easier to go through and not fumble around too much. So the first chart we have here, this is essentially a 30-year chart of the revenue growth. That is the line that you're looking at in blue. The orange line is the number of locations, and that is the axis that is marked over there on the right. So we're up to over 40,000 Starbucks locations at this point. So pretty phenomenal sort of top line growth, if you will, over 3 decades now. And if we advance, hopefully I can do that. We'll see if I can do that. There we are. This is the net income chart, and it is not telling quite as exceptional a tale. Company achieved its all-time peak profits and net income back in 2017. More recently, it had a pretty good year a couple of years ago. But really, the net income trajectory has not been quite as stellar. And we're going to get to some of the reasons why. One of them, interestingly, isn't necessarily this chart, which is what I was referring to at the top, which is the price of coffee over the course of the last year. So it rose from under $2, basically in 2023. And then in 2024, it effectively doubled almost from early 2024 to early 2025. Much of that increase happening in Q4. It had another spike. In percentage terms, it didn't rise quite as much in 2025, but in dollar terms, it did. So coffee prices are up about 100%, maybe a little bit more actually, off their lows. I'm going to come back to this chart in just a second. And this chart right here is the long-term price to sales for Starbucks. So if you're taking a look at this, as you would probably guess, this is reported quarterly. The blue line is sort of the low range of price to sales for the quarter. The green represents the high end, and the white is essentially where it closed at the end of the respective quarter. So you can see that it can essentially merge with either of the two lines depending on where it fell. Right now we're at about 2.66 times sales. And, as we look at this, I'm going to just ditch this, and we can, move on to just sort of take a look at it going into earnings. Here are some of the things to think about. So the first thing to think about with respect to coffee prices, that will not likely affect the quarterly earnings results that we are about to see. And the reason for that is that Starbucks contracts for and buys their coffee 12 to 18 months in advance. So if you think about the roasting that was going on and basically what they were selling in the first half of this year, that is going to be coffee beans that they contracted for or purchased 12 to 18 months ago when prices were considerably lower. However, it is possible that there will be some conversation about higher coffee prices either in the back half of this year or in the years ahead. So the other thing I would point out is that while coffee prices would seem to be a huge input cost, interestingly, the margins on a cup of coffee are quite high. So even though the price of coffee may have doubled, it doesn't necessarily have quite as big an impact as you might think. But still, it could be somewhat considerable. And here's the thing. We saw that net income was kind of stagnating over the course of the past several years, going back to those highs that we saw in 2017. So what gives? So there's a couple problems that have been going on at Starbucks. So since Howard Schultz initially relinquished control of the CEO role, we've had a few CEOs. And some have had better success than others. And in fact, Howard Schultz has twice returned to the helm for brief periods as they tried to identify new leadership. The most recent CEO is Brian Niccol. Brian Niccol was formerly the CEO of Chipotle, and before that, Taco Bell. And he had quite a lot of success at both of those companies. He turned around Taco Bell. Chipotle, his leadership was very highly regarded there. So highly regarded that he got a very nice pay compensation deal, I should say, from Starbucks. He lives in Newport Beach in Southern California and apparently commutes some of the time via private jet. That got a lot of publicity. I wouldn't say it was good publicity up to Seattle for Starbucks. And in fact, actually, when he took over the role of chairman and CEO of Chipotle, that company, wanting to have him run their business, relocated their headquarters to be close to him. So he didn't have to move to take on that role. The company basically came to him. So what are some of the operational challenges that Starbucks faces that he is sort of tasked with resolving? So there have been some studies done on customer satisfaction at Starbucks. Their menu has grown increasingly complex. I saw one statistic that said that when you factor in all of the items on their menu, all of the drink items on their menu, and all of the potential variations that can be had for those respective beverages, that there's something like 100,000 different choices, and that's too complex. I do take a little bit of an issue with that. First of all, I didn't do the math to double check that was actually true. It sounds high to me. But the other thing I would say is that you can't necessarily suggest that a menu has become too complex when you're dealing with something like coffee or frankly anything, when you're dealing with the possibility of customer preference and customization. So, for example, a coffee, can have nothing in it. It can have milk in it. It can have low-fat milk in it, skim milk, half and half, cream, whipped cream on it, cinnamon. These are, in theory, each one of those is, a different option. But, a coffee shop should be able to handle those types of things. I don't think that really makes things too complex. However, they do have a lot of other menu items in the form of food and things like that, which have become more complex. And they tried to automate a lot and digitize a lot of their business. In fact, 30% of their orders now are done through the app. And what this has led to is prolonged wait times. And I've experienced this myself, I have to say. I use the Starbucks app, and I don't do it so much now, but when I was in the city, it's very common to run by a Starbucks. You use the app, you order your drink, and it can be convenient. You get some points. All of that's very nice. But the fact is that if somebody is just waiting on a coffee and they are stuck behind a line of people who have very complex beverages, it is a little bit frustrating because that's all I ever get. And that is a little bit problematic. The other thing that the company has been facing is some other increased costs. For example, wage costs. I'm sure that some of you watching now have heard about collective bargaining. Some Starbucks have tried to unionize, and that has contributed. The company indicated that hurt their net income margins by about 140 basis points in 2024, and that was offset a little bit by some pricing increases and other operational efficiencies. But these are basically some of the financial issues that are hitting the company. And then there's also the issue of quality and perception. So, once upon a time, people would use a Sharpie, write the name of the customer on the cup, and maybe draw a smiley face or whatever. And that has just basically gone to printed labels, and that has sort of taken away the premium experience. People sort of feel like they're shuffling in. So these are the types of things that Brian Nicole has been tasked with trying to improve. Now, he joined the company in September of last year, so, presumably he's been given a little bit of time to try to resolve this, and this could be one of the truer tests. Now, other things to think about. What does the foot traffic look like? So it's interesting. I was looking at one analyst's assessment of what they thought might be happening, and they actually indicated that there might be some kind of an uptick in customer traffic. Now, what's curious about that to me is that when I was taking a look at, so they were thinking that there could be, I'm just going to read here what one of these contributing analysts had to say. I'll just read this off to you because it'll be a little bit difficult if I throw it on the screen. But they were expecting that results could improve significantly versus the first quarter's 4% decline year on year. And so maybe second quarter improvements in the neighborhood of 12.8% in terms of operating margins. They were talking about decreased advertising, less of an inflation impact, some sales deleveraging, and the elimination of some non-dairy milk upcharges, attracting more people into the store, but they could also see some increases in advertising expense. I don't know about that, but what I do know is that I have sometimes brought up on this channel alternative data, and I just wanted to drag this over. We'll bring this on the screen really quickly. And it was this number that I was sort of keeping my eye on, which is Placer AI. So Bloomberg's second measure data suggests that the year-on-year growth could be slightly better than the industry. Placer AI's foot traffic estimated business data, though, is seeing the opposite. So we have a little bit of a conflict in here between these two. Now, what got me looking at this stock to begin with was the fact that, as I previously mentioned, one of the things that this market pullback does is it presents an opportunity for us to look at companies that have had significant declines in price and maybe get into them at more attractive levels. And as I looked at that, this is certainly a company that has fallen back considerably. I have a lot of respect for Brian Nicole and the things he's done both at Chipotle and at Taco Bell. And so I thought, well, hey, this might be an opportunity then to dip our foot in the water, possibly on the long side, getting long the stock at a little bit of a discount. Now, it's a little bit hard to make out here, so I have unusual whales up. This is just a price chart. We get a couple signals in here, potential buy and sell signals. We're not quite there yet. Maybe we would be if we fall back down to this level. So my thinking was, okay, we have a bigger than average implied move. The stock has fallen. We're not quite to a really committed long, but earnings could provide the catalyst. So you might not necessarily get that opportunity. So how can we potentially play it? I was thinking taking advantage of the elevated options premium. Now, we're going to be doing this live. I was looking at this over the weekend as a potential topic, something for us to talk about today. And we did see that some implied volatilities have fallen a little bit, so it'll be interesting to see how this one shapes up. But my thinking was a zero-cost call spread risk reversal might be a potential way to play it. And I actually did a little bit of a back test going back 11 years if one were to use a strategy like this going into earnings, and that is without fear or favor, meaning that I was taking a look at this regardless of whether or not, there was no other indication really of whether one would be going bullish or not. I was just basically picking strategies and taking a look at their performance, and also taking a look at how the stock has typically moved after earnings in the month that followed. So let's just take a quick peek at that before I build the rest of this so you can sort of see why I was thinking this way. So in the month after earnings, the stock has moved an average of about 6.5%. Right now it's implying a move of about 7%. That's a one-day move, so far bigger even than the average move over the course of the month following earnings going back about 10 plus years. So I was thinking, okay, well, why don't we examine strategies that try to capture, something close to a 10% move up or down. And this is what I came up with. So let's just call it 84, get down to the 76. This thing could be put on for something close to even. When I was looking at this, it's a little bit different. So this is the June 6, 76, 84, 92 call spread risk reversal. I think when I was looking at this over the weekend, I got pretty close to scratch. This one is a mild amount of premium that you'd be spending, about 91 cents. So we can probably tweak that just a little bit. Maybe make these the 85s. That's... take these up to the 77s. That's probably about even money now. There we are. So that gets us to about even money. That you can, your mileage may vary. And there's only tomorrow to trade this strategy in any case, because they're going to be reporting after the close. So how would I go about testing a strategy like that to see how it would have done historically? And I kind of wanted to do an even money premium because it'll be a little bit easier for me to illustrate how I think about these things. We can also go back a little bit in time. Let's try the month ending one and see how that looks. Yeah, May 30th. That's also pretty much spot on even money. So that's not going to be quite 10% since the stock is about 83 bucks and change. But let's have a quick peek here and see how this would look. So what I'm going to do now is just dump the results that I was just showing you in that table. So on this Excel sheet, this is the month after price move for Starbucks. It's probably a little bit hard to read, but don't worry too much about reading the data on this. What I'm going to do now is construct just a visualization of how the strategy would have performed in the month following. Okay, so we're going to look at the May 30th ending, so it's basically a month out. Just know that what I have here is 11 years worth of earnings data and how the stock behaved for the month following in every one of those instances. So the stock closed today at 83.90. That's actually up a little bit. And the strikes that we have selected here are the 77, 85, 92. So all I'm going to do now is I'm just going to figure out what the moneyness of each of these is. And that's going to give me a sense of, this is a kind of a quick and dirty way to do this kind of work. I'm assuming other people are going to have access to, all you need to do really is just go back in time and find the historical price. If you have access to the historical prices, you can do this kind of analysis. Because I'm not going back and looking at historical options prices. I have a way to do that too. It's a little bit more complicated. But really what we're trying to do in this case is just say, how has the stock historically behaved if I had the opportunity to put on a similar strategy of similar moneyness for a similar percentage of the current stock price, in this case essentially zero because we're putting it on for zero premium. How would this have done in the past? Okay, so first things first, we have to just calculate what each of these options would have been worth. So in this case, it's going to be okay. So that's the value of the put. So how much can an option be worth? In the case of a call, it's going to be worth at expiration the maximum of either 0 or the stock price minus the call price. And in the puts case, it's going to be the maximum of either 0 or the strike price minus the stock price, right? So here we are. We're just going to say this is going to be string K7 minus P string 3. There we go. Okay, so now we've got the value of these respective options on their dates, and the call spread risk reversal is going to be the value of the call that you bought less the value of the strangle you sold. Okay, so now we have essentially the value of this trade going back for 11 years. And if we want to visualize this, that is not a good way to do it, but this would be. Yeah, let's use a column chart. That should be fine. And there we go. Now, in this particular instance, just understand that I have the most recent data in the front of the chart. Usually, as you think about this as a time series, the last period to the right is going to be the most recent, but that's not the case here. To make this a little bit clearer, why don't we just throw the relevant quarter and stuff like that in here so you guys can see what it is that we're actually looking at. So here we go. Oops, wrong column. That's the one. So this way we can see which quarter, which year we were actually talking about. And because that's not, I think this looks a little bit washed out, why don't we choose a darker image. There we go. Okay. So as we take a look at this, you own a call spread. The reason that these things all peak out over here is because you're buying a call spread that is 1.3 and 9.7% out of the money, respectively. So the maximum value of that is going to be the difference between the two strikes, which in this case is 8.6. And you can see that you actually capped out in a couple of instances. You can see that there were several quarters where you didn't make anything. So that meant that the stock either stayed right where it was initially or it fell slightly. And in a couple instances, there were some fairly significant losses. But, for example, back in Q2 of 23, would have lost 6.5%. So obviously a huge decline because you're selling a put that's more than 8.8% out of the money. Same thing here. But in general, what you can see is that the results of doing this, and this is not factoring in any of the fundamental analysis or the technical analysis, is just assuming you did the trade every single time, how would you have fared? And you can see that you would have made the max profits several times. You never would have lost as much as those max profits would have been. And if we take a look at the average result, the average return is about 2% of the current stock price. So what are the risks in a strategy like this? You put the trade on, and there's a chance that you can have the stock put to you at that lower put strike, which is a decline of about 8+%. Now, you may remember that one of the reasons that I was looking at something like that was because, technically it's not a phenomenal setup here. But we have an upcoming catalyst, so that could significantly change things, right? So the idea here is that rather than just going out and buying the stock, put a trade like this on. Worst case, you're going to own the stock down near levels of potential support that we've identified. This is actually a little bit higher than that. Ideally we'd be a couple bucks lower, down around $72 a share or thereabouts. But it is what it is. We don't always get every single thing that we want. And I think that is the case here. Okay, so just to highlight what we're talking about once again, Starbucks, if you're inclined to get long here, these are the types of trades, by the way, that you would only really be interested in doing this because you may know that in the past I've often said, I don't like necessarily doing covered calls going into catalysts such as earnings unless the setup is particularly compelling. A call spread risk reversal has elements in common with a covered call because you're capping the potential upside. This is not entirely dissimilar to a covered call. I'm actually going to illustrate this in case that doesn't seem clear, which I can understand why it might not. But I just want to show that there are some commonalities between a call spread risk reversal, a short put of similar expiration. There we go. Okay, so if you look at this, you can see effectively that you get a decent standstill rate of return, have a 60% probability of profit in that instance. You'll end up owning the stock at $85, essentially less if you sold this put. Actually, this is covered call, but synthetically it's the same thing. Less the premium collected. You can see that this put has a very similar sort of payoff, and so does this call spread risk reversal. In each of these instances, you are short premium. And the only reason that I'm kind of thinking that this might be a better setup now is because of a couple of factors. One, implied volatility is quite high, so I'm more inclined to be short premium. Like I said, the implied move, 7% for one day. Typically, over the last 11 years, this stock has moved about 6.5% over the following month. So elevated options premium, that's the first thing. Secondly, the stock has fallen a decent bit, but I do think that we're kind of still in this choppy environment. Is it possible that Brian Nicole tells a story that is so compelling that the stock regains some of those prior highs or even the highs that we saw earlier this year? It's possible. I think it's a bit unlikely, though. I think they probably will speak to the fact that if coffee prices don't come down, they are going to have to contend with that. Huge thing? Not necessarily. Wages, there are some other bigger issues for them. But, all of it counts, right? 100 basis points here, 100 basis points there on the net operating margins, and these are problems. The other thing I would say is that it isn't just about operating. I was reminded of a quote that Warren Buffett said that, and I'm going to probably butcher this as I paraphrase it. We can probably look it up. But essentially what he said is when a bad business meets good management, it is generally the reputation of management that gets lost. In essence, and that was paraphrasing it, but effectively what he was saying is that even the best managers are going to struggle operating a bad business. And I'm not saying that Starbucks is a bad business. It has demonstrated over time that it can be quite a good business, but it is dependent on the consumer, and we know that the consumer is in a little bit of distress. And it is somewhat dependent, of course, on the availability and price of coffee. And why are coffee prices so high? Well, one of the reasons is good, which is that in some markets like Asia, apparently Russia, and some other places, coffee culture growth is still a thing. People are drinking more of it, and there is some pivoting from other consumer behaviors. But the other reason that prices have been going up isn't so positive. It's not demand-driven, it's supply-driven. There have been some climate issues that have affected Brazil in particular, which is one of the largest coffee exporters in the world. Apparently, that clipped their coffee production by about 25%. And again, let me just bring the chart of coffee back up here again so we can have another look at this. Arabica is the higher quality, Robusta less so. Arabica beans are the ones that are going to matter most to a Starbucks. Now, the interesting thing is that the United States, we don't grow coffee. And the reason we don't grow it, except in a very limited quantities in Hawaii, is because it's a very specific climate and a very specific altitude at which it grows. And Hawaii is the only place we've got it. So this is an import crop. And by the way, you know, in the midst of all of this tariff stuff, this hasn't really come up, but it's worth noting that, you know, if we get into too much of a battle royale over things, that there are things that we import that we can't get anywhere else. We can't replace imported coffee in North America. Now, that doesn't necessarily affect all of the other locations for Starbucks, because they're not necessarily going to have import duties imposed on them. If Starbucks retail locations, if they are roasting and selling coffee in Europe, they're not necessarily going to be subject. It doesn't have to pass through North America first, but you know, it's another area of complexity that deserves some thought and attention. Finally, just to talk a little bit about the fact that we're looking at higher than average implied volatility. Let me see if I can blow this up a little bit so you guys can see it a little bit better. So over here in this section where it says implied volatility, I'm going to put a little box around this so we can see what I'm talking about. Vol crush. So this is when we're talking about the change in implied volatility that we can expect from the moment before earnings comes out to afterwards. And this is the before, so you can see over here the most recent reported quarter, 37% implied volatility beforehand, 22% thereafter. Why do I bring this up? Because in that back test that I was providing with all the columns on it, what I was showing was the P&L if you held that position all the way through to expiration. The thing is that if volatility comes in, you're short more options than you're long. Particularly, this is going to be true if you are able to get that call spread risk reversal on essentially for no net premium outlay. This volatility crush is going to help you, which means that you may actually be able to capture some profit before expiration. So we saw that that was what would happen if you just set it and forget it over the past 44 reported quarters. But because implied volatility is high and you're playing a little bit for the crush as much as anything else, you know, we've seen some pretty significant declines in implied volatility after earnings. And I compare and contrast this because last week we were talking about Tesla, and Tesla was kind of an interesting case because you didn't get quite as much of a vol crush as you might expect in Tesla's case, but it's pretty profound here. Okay. So with that, I think we can probably move on. Am I going the right way? No, I'm not going the right way. Whoops. Let me get rid of this. All right, so let's take some questions. So, oh yeah, well, let me just bring this up. I don't know who asked about Trade Desk. Somebody asked about Trade Desk last week just as we were wrapping up. Kenny Clutch, I think, referring to Starbucks here, saying they need better food. Well, you know, the problem with this is that they don't prepare food at Starbucks. You know, they basically have prepared foods and convection microwaves, right? So you take some pre-made something out of cellophane, stick it in that thing and hit a button and heat it up. That's about as good as it's going to get. I agree that to achieve the sort of premium coffee house experience, it's a little bit tough to have a cold case filled with cheese sticks and ham and cheese sandwiches or whatever from God knows when. You know, it's interesting because it was in the course of doing a little bit of homework on the history of Starbucks that I learned that they acquired a chain of sort of premium coffee shops called the Coffee Connection. I don't know if anybody watching is familiar. I am familiar with the Coffee Connection because that was, you know, where I went to school, which was just outside of Boston. They happened to have coffee connection in Harvard Square. And, they would have a French press, and it was quite elaborate, very premium experience, and they had nice food. You could get a very nice sandwich there and all of that. And when Starbucks first started, I think it was a notch or two higher in terms of the premium experience than it is now. Ceramic mugs, stop, linger, read a book, and all that kind of stuff. And now it's in an effort to become more efficient, more digital, more takeout. Each one of these things in its own way sort of brought the experience down a little bit. And not all of this was the fault of management and the company. Example of this was simply the ability to customize your own drink after the fact. So you could go and grab your napkins and put a little bit of half and half and a sprinkle of cinnamon and stuff like that on your coffee if you wanted it. And during the pandemic, I'm not sure how it is where you live, but where I live, they eliminated all that. They didn't want anybody touching anything, so you could no longer do that. And apparently these are among the things that they're going to try to bring back, which I encourage them to, and I think that's good, but that is an issue. Okay, so Trade Desk, this is an interesting one because this is a stock that has absolutely been annihilated. I think it's down like 60% or something from its highs. Let's have a peek here. Might as well give you the exact-ish. So where were we? Here. 62, yes. So over 60% it's down from its highs. Interesting situation, right? Because we have a little bit of... Yep. Okay, so actually I'm just going to quickly address this question. And maybe we can apply it to this. Do you prefer iron condors or strangle swaps for earnings? The TastyTrade guys really love diagonals, calendars, strangle swaps, pros versus cons. Okay, so I like calendars. I like diagonals a lot, and I really also like strangle swaps. Condors, not so much. And maybe that's a little bit unfair, but usually one of the reasons I like strangle swaps is that, a condor, it's a lot of legs on one side. If I can, not always the case, but if I can, have a chosen direction, that's one of the reasons I often like diagonals. Buy a longer dated call, for example, I think the stock's going up, usually almost like a poor man's covered call, but you can own a longer dated bit of premium and sell something near dated, capture some of the vol crush, get a little bit of delta, limit your risk. So you have a bunch of things that are potentially working in your favor. Now, every situation is going to be a little bit different. So, for example, let's take a look at, we'll just walk through it with Trade Desk and sort of see what we've got going on here. No, we won't. Well, we can, I guess, but they're not going to be reporting until next week, it looks like. So what day is the 8th? The 8th is next Thursday. Yeah, I guess we could look at Trade Desk. Why not? So let's just assume, so that we don't get too bogged down. Let's just take a quick peek at the financials here. But we'll start with the general thesis that phenomenal grower was just too expensive. But now, finally, you've got a fast-growing stock that... so somebody else is saying, Alex V, I'm probably not going to go back to Starbucks too much. Is it part of my Holly index or not? It isn't really. My wife does not spend a lot of money at Starbucks. She used to once upon a time, but not so much anymore. Her preferences these days are... So we have... in the Bay Area, Blue Bottle if you're in the city. We have Red Whale coffee is close to us. The closest place to me, we'll actually have a Starbucks about a half a mile that way, and a Pete's equidistant about that way. Maybe the Pete's is a little bit closer. And Pete's, I think, got acquired by the folks of Starbucks some time ago. But that has a slightly more upscale experience. Pete's does. Yeah, I think... No, it's not on the Holly Index. Short version, right? So we drink a lot of Starbucks coffee at home, but it's not on her Holly Index here. Interestingly, Tesla is, but anybody who reads the New York Times who's watching right now, you might have seen there was an article in the New York Times over the weekend. And I think a part of the title of that article was Trouble in Teslaville. And they highlighted the fact that, I live basically, in the epicenter of Teslaville. And actually, it's not quite true. I think the percentage of Teslas as cars is a little bit higher on the peninsula and, down near San Jose. But this is one of the highest in the country. It's the most common new car here, probably by a good margin. Or it was, until people started getting all up in arms about Elon's political affiliations. This area, the town of Mill Valley, according to the New York Times article anyway, over 80% voted for Kamala Harris. Kamala Harris, excuse me. I have mispronounced that a couple of times, and so I think I got that right this time. And now a lot of these Teslas have, anti-Elon stickers on them and so on. So in this area, Starbucks is probably not, the preeminent one. But we have a lot of different coffee shops, so it's kind of a thing up here. Maybe not as much as Seattle, but Illy Coffee. Yeah, Illy Coffee, I like it. I like any coffee that's got a good strong flavor. Full-bodied coffees. I like full-bodied coffees. I like full-bodied wine, Cabernets, things like that. So anyway, okay, let's get back to this. So here we are. We're taking a look at, and let me blow this up so you guys can see it a little bit better. So we can see that the top-line growth for Trade Desk is forecast not to grow quite as quickly as it has historically, but still, and this is the magic number that we're looking at over here. Oops, what did I just do? That is not the magic number. So I just hit the wrong button somehow. Let's bring this back. And I'll blow that up again. Okay, so let's see if this works. Does it work? No, that button is now doing something different than I thought. So I'm going to ignore that, and you will forgive me as I fumble around over here. This is the advantage of doing PowerPoint slides and having somebody else drive, because not my forte. It's clear. So full year 2026 numbers are estimated to be close to $2 a share. All right, so let's just use round numbers. $50, $2. That's 25 times forward at a 25% year-on-year adjusted EPS growth rate. And there's a lot of moving pieces going on here in terms of the advertising landscape. We ought to realize that it's not entirely clear. You've got customer privacy laws, things associated with cookies and tracking. Is Alphabet facing antitrust issues? How long is that going to take? So when we think about advertising optimization, there's a lot of moving pieces. But I have to say that we haven't really had an opportunity to consider Trade Desk at anything that approached a market multiple until now. So we'll just start with that as the basis of our sort of framework for the conversation about condors, diagonals, and so on. So let's just say that from a fundamental perspective, we kind of like it. Just because it's a growth stock that appears to be getting to a reasonable valuation. I would think we can all agree that if you have something that's growing adjusted EPS at 25% year on year and you can buy it at 25 times next year's full year earnings, that's a positive. Technically, and this is also no big surprise, I'm not sure if you guys can make this out. I will try to blow this up as well. But these little arrows over here on the left are the things that you want to be paying attention to. Down arrow is this technical indicator would be a seller or has an existing short position on. That's reflective of the P&L associated with that, using $100 million as a basis. We can see that most of the technical indicators, and certainly the top 5 of them, are not that positive at this moment. But we've got a fundamental view. So now we want to take a cautious, bullish perspective on it, even bearing in mind that from a technical standpoint, the setup doesn't look so phenomenal. So how do we do this? And this, by the way, if you can see it over here, also still a little bit washed out, but right over here in options play 2, we can see that it's got a 1-month neutral technical setup. 6-month is bearish. 1 month might be what we're really interested in. Why is that? Because we've got earnings coming out. So that's the catalyst. We have something that we know we're looking at, and that is going to be the catalyst. And now let's also, one last thing we want to take a look at. We might as well use unusual whales for this because it has a very nice little display here for volatility. So why don't we get a little bit of perspective on volatility here. I'm going to just bump this out to about a year. I don't think I need to ask you guys to guess what these humps are. Okay? So what those humps are the implied, that's the implied volatility for a trade desk. And these little humps, guess what they are? Earnings, of course, right? So we can see from that you do get a little bit of a vol crush in all of that. And now we're just to take a quick peek at earnings. Are earnings implying a larger or smaller than average earnings related move? And what we can see here is that the expected move is about 14% less than the move that we saw last quarter, but that probably washed out a lot of bad news, but bigger than almost every period other than that, save one, right? So looking back at 11 prior reported quarters, 9 of those had expected moves less than this one. Now, we can also see that the realized moves were actually pretty sharp. So this has some utility for us. But okay, so let's just assume then we've got a good enough short-term implied volatility to be willing to sell it. What then? Okay, well, let's create a couple structures and see what we think of them. Let's start first with the strangle swap. So more of an agnostic direction. Strangle swaps will generally skew a little bullish. So they will do better. Let's just say we take the expected move, the mean absolute deviation, and we trade a straight calendar on the upside expected move and a straight calendar on the downside expected move. What you'll find is that the P&L to the upside is going to be a little bit better. So, looking out to next week, expected move, we've got stock's about $54 right now. Let's call it $9. That is chunky, huh? So we're looking at, yeah, okay. So if we're going to construct a strangle swap on a $54 stock price that looks a little bit like that, we can just do that very quickly here. You referenced the Tasty guys, so why don't we just pick the tenor, that is the amount of time to expiration or the maturity of the options that I understand they typically prefer. By the way, when they say, this is kind of an interesting thing, when they say sell at 20 delta strangle, that will match, in general, the expected move. So one standard deviation, it's going to be whatever, 68. It's going to capture 68% of the events, but one mean absolute deviation will capture about 60. And the difference is going to be the standard deviation times square root of 2 over pi. Don't need to memorize all of that. It's about 80%. 80% of one standard deviation up or down is the expected move. That's also going to be the 20 delta strangle, meaning short the 20 delta call, 20 delta put. So you don't need to do a whole lot of math, but if you happen to have an application like this one, it's actually going to show you this. So we're selling an upside call. Whoops, call, there we go. So I'm just going to zip around here a little bit. Forgive me. So what are we selling? 20 delta call and put, give or take. That should add up. What did I say? The implied move was about $9. Stock's $54. 45 strike put. Okay. The call, the 20 delta call, is a little bit higher than that. Going to give ourselves a little bit of upside room. So then, if you're going to do the strangle swap, I want to make sure that I'm capturing the next event, because otherwise I'm just going to get walloped by the vol crush anyway, and I'm not giving myself more time. And also, if you're going to own longer dated options, why not hold them for a while and give yourself something to shoot against? So, you know, if you're going to hold this and let time pass, and then you're going to say cover it with 20-ish days to go. So if you sell a 45, let's say a month and a half, so you sell a 45-day strangle, you want to cover it with 3 weeks-ish. Why is that? Because basically the premium on those wing options is going to be dwindling down, and that relative to the stock price, you're collecting a little and risking a lot. So anyway, and I believe that the guys at Tasty have done quite a considerable amount of work on this. They're thoughtful. I'm going to trust that their back tests have been looking at this fairly well. Okay, so let's take a quick peek here. Next earnings is after this one. So next Thursday, and then August 8th is estimated, so all it's doing is advancing the clock. But that means that, yeah, well, I guess we'll just take September. Why not? All right, so you get a strategy that looks a bit like this. And, you know, according to this one, at least 80% probability to profit. Impact of the vol crush on the longer dated options, not completely factored into this. There will be some impact. If you have an option that captures 2 events, implied volatility is going to be higher than if it captures just 1. Under normal circumstances, the volatility term structure is going to be upward sloping. So what does this mean? As time passes, longer dated options applied volatility is likely to fall a bit. What this tells us is that if you, a couple ways to think about it, but one way you could think about it, which I think is a reasonable way to do it, is that the decay of those longer dated options is a little bit understated, because you have a combination of theta and the fact that you're sliding down the term structure a little bit. But the fact that it captures September means that what actually is going to happen is it could fall off, and then it'll sort of stabilize, and implied volatility will actually rise going into the event because of the event variance. But, you know, you will want to manage this before you get into that situation. But this is, you know, I think a very reasonable and attractive strategy. So the downside break even is 41.63 on this, according to this, but let's just call it $42. Let's call it 42.5, I think. I'm just going to make a little bit of adjustment, assuming those longer dated options lose a little bit of vol. So, you know, that's going to get you down 20%, up 20%. It's a pretty good range, right? And could we get another big disappointment? I mean, it's certainly possible. But, I mean, a lot of bad news has been baked into this cake. And, you know, the total amount of risk, because this is a $5 strangle swap, yeah, it's 10% of the stock price. To risk 10% of the stock price on a stock that moved down 30% or whatever it did on the last earnings, you know, that I think is quite acceptable. And the truth is that's not really what you're going to, if it's anything within these boundaries, if it stays within 20% of the current stock price, you're not going to lose all of this premium. So that's not really the max risk in that case. So there we have it. So we have I think what is starting to look like a more favorable setup on the fundamental side. Technically, it's still a little bit weak. Volatility crush for trade desk, pretty good. It has had some big moves. I'm taking a flyer here by suggesting that the move isn't going to be a whole lot bigger this time, but you know, I'm wrong plenty of the time too. I could be wrong about that, but I don't think that's a bad setup. So now let's compare that though. Let's just say for the sake of argument that you had more of a directional bias. Okay? And so you said, all right, you know what? I'm just going to skip the put side and I just want to do a diagonal. All right? So you could do it like this, or you could lower the strike of the one that you are buying. And as you do that, there's a couple things that will happen. I don't know if you can tell, but you see how the right wing of this is moving up as I make that adjustment. If you are really bullish, what's the worst thing that could happen? You take a posture that you think is bullish, the stock does what you think it will, but you end up losing money. Well, how would something like that happen? Now, again, watch the right side of this for just one moment, okay? So let's say I just did a straight 70. Do you see how that slopes down on the right side there? Okay? So the advantage to doing a diagonal, you spend more premium, but you can adjust it so that if you buy a diagonal spread and you spend less than the distance between those two strikes, there's no upside scenario where you ultimately lose money. In a straight calendar, that's not true. Whether it's a strangle swap, put spread, call spread, whatever it is, if you have either a diagonal spread where you're spending more than the distance between the strikes or a straight calendar, the stock can move in your desired direction, but if it moves too far, too fast, you can actually lose. And the way to think about this in options parlance is that you're short gamma. That means that the delta of the nearer dated option is going to increase more rapidly than the delta of the longer dated option. If I trade an upside call calendar spread right now, that is a long delta strategy, meaning that as it gravitates towards that strike, I should be making more money. But because the gamma of the short option is higher, it's gaining deltas more rapidly than the longer dated option I have. And if you get a hugely sharp move on an event, that's when that kind of can sting you. All right, so that's that strategy. Now, let's just quickly imagine that you just did a condor. All right, so a condor where you are, let's do an iron condor. So you sell a downside put spread, sell an upside call spread. That is going to have a payout that looks similar to the strangle swap one that I just provided. It's not going to have any curves, though, because it is definitive as of expiration. So let's just shorten this up so I can make it a little bit clean. Let's just say that I used May regular way. So we're going to have two puts. We're going to have two calls. We are going to, let's say, I need to sell a put and sell a call, and then we're going to buy the wings. So we're going to just say, maybe I'll make this a 20. For simplicity, I'm going to make this about a 20 delta. So I'm going to sell a 25 delta put. I'm going to sell a 25 delta call. 30 delta, okay. And then I'm going to buy something that's a little bit further out to cover it. And you're going to see what happens here. Okay, and I need to buy a further out of the money put here. And there we go. And you can, tinker with these strikes however you will. And you get a strategy that looks like this. What are the advantages of doing this versus the strangle swap? Well, one of the things you've done, especially if you make it very short dated, is you've kind of taken this longer term volatility assumption uncertainty out of the equation. Right? So this is simply a play to expiration. We could actually make this just until next week. Okay? So they report on after the close on the 8th, or I think it's after the close. We can double check that. And these options expire on Friday. So this is a very strict payout. This is what would happen by the end of next week. If it stays within that range, and notice the probability of profit here is about 62.7%. If you're shooting for the implied move, that's about what you're going to get. Okay? So And that you can also see it's pretty close, right? So we're 54.40. This is the 48s. This strike should probably be a little bit lower. But remember, you're collecting some premium. So the break even is going to be the put strike minus the amount of premium collected, and the call strike plus the amount of premium collected. So we're collecting almost $3. So $48 minus the $3 almost that you're collecting gets you down to a $45 break even, just above. So about $9, the expected move to the downside, and so on. You guys can kind of see how that works. Yeah, Monday Morning Quarterback says, when would you enter the trade desk trade? Presumably after Meta earnings. So this is a good observation. And you know, sometimes there's really obvious read-through. What do I mean by that? If I'm looking at earnings for United, that probably will give me a good sense of what's going on with Delta. Or Delta, I think Delta reports actually before United does, but you guys get the point. So you have two very closely related businesses that serve the same markets, similar demo. You can get some good read-through. Meta, Alphabet, these are businesses that rely on ad spend, and that's what Trade Desk does. So you can get a sense for the market by taking a look at them. And I think that's a good observation. The flip side of that is, though, that options markets aren't completely ignorant of this. So there's a little bit of an offset. That is to say that the implied volatility of the options you sell are likely to come down a bit as new information gets into the marketplace. So it's not a completely free lunch. But yeah, I do think that makes some sense, particularly if you spend some time listening to the conference call and really try to get some sense of what's going on. So that's not just true in this case. That's just something to think about in general. I think you want to do that. And by the way, for anybody who's wondering, Meta is going to be reporting in a couple days here, so we can take a look at that one too. Finwest said Starbucks had a 2-for-1 on all their drinks last Thursday here in Thailand. Lines out the door. They were wearing smiles, but all were exhausted. You know, that's interesting because I think one of the things that was being said about, it's funny because I saw that after the Chipotle call, one of the points that was being made is they really want to make an effort to see that the servers at Chipotle, are doing so more with a smile on their face. I will tell you that there's a Starbucks, not right in my town, but in the neighboring one, where on 2 or 3 occasions, because it's close to the dog park, I stopped by there, and one of the women that worked there, I actually posted a little bit of a review, just super, super friendly, and I thought, it's probably not the greatest job to, make coffee for a bunch of people in a hurry all the time, but I thought really did a nice job. Okay, I see I'm on the clock here as well. Let's just quickly punch through this. Meta, kind of like this one, just because it's a cash flow generating monster. I think we talked about this a little bit last week. People are going to be asking for AI monetization. They're going to be complaining about CapEx. So I don't need to rehash this too much. Remember the metaverse. I'm not going to call it a debacle because it was an investment that didn't pay off, but it did demonstrate that management, specifically Mark Zuckerberg, was willing to pivot if his vision didn't pan out. So okay. Isn't this too much risk saying price target is $39.45 with a high PE? Too much risk. Price target of $39.45. So I'm assuming you're talking about that downside break even on Trade Desk. It has a high PE now, ish. But don't forget that the earnings numbers I'm looking at, and what you should always be looking at is what are your estimated earnings, free cash flow, whatever it is you're looking at in the future. When you buy a business or you buy a share of a business, you are not buying what they used to do. You are buying what they will do. So, and that's where the uncertainty is. That's why it's not just a science, it is also an art, because you have to kind of read through the lines and see whether you agree or don't agree with the assessments, whether you think that and don't forget, in many cases, these estimates, the forecasts that people have, they may not be getting updated in real time. And, I ran afoul of this a few years ago. I might as well just tell the story. It'll be a quick one. When I was at CRT Capital, I was not on the research side. I was on the trading and strategy side. I got brought over the wall for some analysis on a company. Doesn't really matter what it was. Obama was president at the time. He was going to be running for re-election. It matters because it's this underpinning company we were looking at was Illinois-based. They were running afoul of some EPA rules, and the company was potentially going to be under some duress, but it was a very old company, employed 14,000 people. So the question was, would Obama's administration put an old Illinois company out of business because it was running into troubles, and they had these environmental fines. Anyway, at the time, because I had been brought over the wall to deal with this situation, I was in touch with the research analysts, and they were frantically at work analyzing this company. They were about to release a new updated research report on it. And I was on a conference call with salesmen, traders, all of these different people at the firm. It's a, kind of like the morning call. And because I was tasked with taking a look at some of this, people were impatient. They wanted the answers right away. When are you guys going to come out with this new research report? And I said, we're working on it. It's coming out soon. And I hung up that call, and immediately the general counsel and the head of compliance called me up with a, what the F are you doing? I was like, what do you mean? What did I do? And they said, you said that we were coming out with a research report soon on this company you guys are looking at. And I said, yeah, that's right. They were asking, when are you guys going to have something? I said, you can't do that. I said, I can't say we're working on something? They said, no. You can't say we're working on something. You can't say you're about to release a research report. What is my point in all of this? That we don't know, the rules have gotten so strict about this, Reg FD, all this kind of nonsense, that as these firms are working on putting out new work or they're changing their estimates, maybe they're about to release it, maybe they're not. But what I'm saying is read the tea leaves yourself a little bit. Because they can't say, they have to really get all their ducks in a row, and then it just gets dropped. And that's why when you take a look at this, $1.97 a share, I think, is the adjusted EPS number full year 2026. And the stock's trading $54. Round numbers, we'll call it $2, we'll call it $50. Okay? If you really want, okay, we'll round it up. $54. Call it, I'll tell you what, we'll round it up to 55. Keep everybody happy. So $55, $2 a share. So what are we looking at? 27 and change times on a 25% year-on-year growth rate. Expensive? Not terribly. I mean, the S&P was trading 24 earlier this year with nowhere near that kind of growth, right? So expensive if you just take a strict look at the number and say, oh, well, 27 times, that's more than the market of 24, which it was earlier this year, or 20, which is probably where it is right now. But the market's not growing at 25% a year, right? So then you have to say, okay, well, is that 25% growth rate reasonable? And if it is reasonable, then you could say, okay, I'm going to live with this. So I don't know that $39.50 for this thing is massively expensive. Okay, so we have audio lost. Somebody lost their audio. Somebody's laughing out loud. Lemur's laughing out loud. About what? I have no idea. Share the joke. Or maybe I'm the joke. Could be. Alex V. Schwab is settling a class action. If you had Schwab or a TDA account, Jonathan Corrente et al. Versus the Charles Schwab Corporation. You know what? I have not been following that, so I can't really comment. Don't know. But yeah, let's see here. Okay, so I had a strangle swap on Palo Alto Networks. Back month was 2+ months out, had the same implied volatility as 6 months out, approximately 45 after earnings. All of the far out options dropped from 45 to 30. Yeah, Lemur talking about the research report. Yeah, I didn't find it very funny at the time, I have to say. I thought it was full-on ridiculous. I still think it's ridiculous. I think a lot of... It's exasperating. I mean, they come up with laws, they come up with rules that just don't make sense. And actually, just a little bit of a background here on Reg FD, which is fair disclosure. There was an analyst... Well, there's a couple analysts that were really well known as we went into the tech bubble. Henry Blodgett at Merrill, Jack Grubman, I think he was at Solly. And these guys were putting out research reports that were very bullish on the stocks that they covered. Henry Blodgett, actually probably most famous for this. And at the time, analysts were really rock stars on Wall Street and were getting paid huge money. These guys were getting paid millions of bucks a year. And it turned out that very often they would put out a research report that said strong buy on a stock. But if they were having a private conversation with an institutional client, they had a very different story to tell. So that was viewed to be very unreasonable because the news would report, oh, Merrill Lynch comes out with a strong buy on junk.com. Or Jack Grubman loves, XYZ.com or whatever it was. And that gave retail customers the perception that this was a good idea to get long the stock. And privately they were telling institutions you shouldn't own it. Now, I definitely don't believe that people should be speaking out of both sides of their mouth. But the other thing is, what loyalty do analysts of a bank owe to people who aren't customers of that bank? And if you are a customer of that bank, aren't you therefore entitled, for having spent $1 million a year, let's say, in commissions to Goldman Sachs, other than just speaking to those analysts, to get what they really believe? I mean, you are paying for their research, their insights, and access. Corporate access, meaning that they can get you introduced to the respective management. When I was at Ivory, it was not an uncommon thing. We would get managers on the phone, or we would even have them come to us. We had the CEO, the CFO, and the head of investor relations of Canadian Oil Sands come and sit in our boardroom to talk to us. And we were just a bunch of kids. Why? Because we paid a fortune in commissions. So my question is, there has to be a balance between what banks, research departments owe to their customers, clients, people who pay for their research, and some random person off the street who isn't a customer, who doesn't pay them anything. I mean, I'm not exactly sure why they are entitled to have everything at the same time. Now, I don't think they should be permitted to say publicly to retail, go out and buy XYZ, and then to institutions, sell XYZ. That's no good, but there has to be some balance. And it is utterly ridiculous in circumstances, in my opinion, that you cannot even tell your own colleagues that you are working on a project. Not what it says, not what you're going to, but you can't even mention that that it's in process to your own sales team, your own traders. I didn't give them insights into anything. Just amazing. Some investments that I can buy with upside for buying the common, but I'm having problems. What are the best okay. Yeah. Monday Morning Quarterback. Great movie. I'll tell you, I mean, this is, I have to say, one of the things I always loved about the people who work on Wall Street liked the movie Wall Street because it was kind of a Cliff Notes. It captured some realities. Not perfectly, but there were parts of it that were really kind of remarkable. You know, the distinction between the retail side and investment banking. Now, the idea that somebody would move from being a cold calling retail broker to an investment banking role, that doesn't really fit. But I liked the fact it captured a lot of the elements between the salesmen and the traders and stuff like that. So Michael Anthony's asking, what are the best sectors to buy if we're in a recession? Utilities, staples, all the same old stuff. I'm not telling you something you don't know, but actually utilities sold off a lot because it was a hot sector. It was a hot sector because people were playing it as a demand side thing on the AI data center. And that's true. You know, our demand is going up. So I actually would stand by that. We're having a slowdown in the EV sales department right now, but that's not likely to last. I mean, we are going to see more cars are going to be EV as a percentage of the overall vehicle fleet in North America in the future, and that's going to also create demand. Population continues to increase, and you know, I don't hear a lot of people talking about it, and maybe they're not talking about it because they don't believe it's possible. Sort of industrializing. That is to say that suddenly someone's going to say, oh, we're going to impose these tariffs, so we're going to build some more plants in the United States. We have built plants in the United States. BMW has it in South Carolina. Mercedes has it in Alabama. You've got Honda in Ohio. You've got WeatherTech floor mats. You know, those guys built new factories. So we can build factories here. We've got some factories in Texas that have gone up. If we built more of these, industrial demand for electricity is a real thing. So that would be another potential source of growth. Because actually generation has been relatively flat here. So if you imagine there's going to be a build-up, could be a good space. And it's relatively stable, pays good dividends. So if you're concerned about recession, you know, it's boring, but it's true. Those are good places, low beta. And especially if you're just trying to chew along and save for the long term. You know, if you can buy these things at between 16 and 18 times forward, which is probably about where they are, and they're yielding 2 to 3%. It's not a bad investment. Is it super sexy and exciting? Yeah, probably not, but that's a good place to be. Alrighty, guys, I have kept all of you for a very long time and well past the allotted hour. For those of you stuck around, I really appreciate it. Hearing me drone on. Surprised that anybody can put up with it, but I'm glad that you did. And like, subscribe, notification bell, put more questions in. We did get to Trade Desk a little bit. We got to some of your other questions, so if you put them in there, I am looking. Don't always get to it. I ramble on about other stuff, but sometimes I do. Thanks for watching.